been a really long time. It's been a while. But I'm back and I want to make a little bit of a pivot. I've been really busy with school. I'm just trying to get my degree and hopefully get a really good job or potentially create my own business. Here to talk about Shopify, um, an investment thesis for Shopify, and how I feel about it. Right now, let's talk about what Shopify is. So, if you're not familiar with what Shopify does, basically, they're an e commerce and they allow businesses to create websites for them to sell their products and services. And these products and services can be physical and they can be digital. There's all these different type of plans. As you can see, they seem relatively similar. These accounts give you more access to more staff accounts. Basically, what that means is more people will be able to make changes on your website. Inventory locations, so you can have more inventory locations where you source inventory from. Cool. SSL certificate. I know this is important for security. Reports. This is very vague. I'm not really sure what that is. Third party calculated shipping rates. Okay, it's an interesting thing. There's definitely differences in the plan. The biggest one I can see is obviously the payments here. They're taking less of a cut, so they're taking basically 2.9% plus this 30 cents Canadian on every credit card, except Amex cards, which are actually higher. This seems really high, not gonna lie. So competitors might have a competitive edge against them in this space, but that's a very minor thing if you're a brand leader like Shopify. Something I see here is their plan is actually subsidized. This is a very similar strategy to what Netflix actually created. If you see Netflix, over time, their subscription cost it's gotten more expensive essentially, and this has basically happened across every single demographic. But they're basically able to subsidize it for a little bit to try to get you as a long-term customer. And yeah, this works with some businesses. We'll see if it works for Shopify though. Let's take a little bit more of a deeper dive into the financials. But yeah, let's take a look at their income statement. This is a metric basically for measuring net income and revenue, which is one earning metric. We'll talk about other metrics that I really like. You have to look at many different metrics to kind of judge if a company's making money. And that's like the basically one of the biggest underlying factors of how returns are returned to you as a shareholder. I like to look at it on an annual basis because every quarter is only a few months, and those are quite volatile. But over periods of years is where you want to see real returns on a net income statement. You can see they're having more trouble here clearing net income. I would say it's mostly recessionary woes, probably due with the shipping, like the shipping problems in the logistics supply chains. Albeit I've heard they've gotten better recently. Shipping containers were like $20,000 like a year ago. Have come down significantly since then. So that's really interesting. They didn't pay taxes, or their effective tax rate is negative because they don't make any money this year. Um, yeah, let's go to my favorite metric. This is free, like not this graph, but free cash flow. Um, you can see they generated $573 million in free cash flow. This is like basically one of the best metrics for determining if a company is profitable. It's up 90% from the previous year. Very impressive. But you could see that they're doing a hefty amount of investments. So they actually have a net income of $2.91 billion, and they're only returning about $600 million. So they are spending a lot of money into infrastructure. Spotify's recently had some free cash flow problems, and this is why their stock is traded down like 70% on the year. You could see here it was trading at like $184 a share just a year ago, and now it's 50, and that's a crazy reduction. Um, it's even gone as low as $33 in a year. So this is a very, very volatile stock. I think it has to do mostly with investors moving more into secure stocks like Canadian dividend bank stocks or other U.S. dividend payers that are really more value, and they're not going to go out of business like Coca-Cola. Like, I would be very surprised if Coca-Cola went out of business. Just these growth companies that basically post very slim free cash flows and earning metrics aren't being favored in this market, mostly because of inflation and the Fed. I want to talk about one thing that Shopify is doing to kind of address this. I wouldn't say it's really a smart decision, but you guys can tell me your opinion on this. So basically, Shopify signed a lease for 15 years, 1-5, and it was owned by Ali Properties in Ryokan, two really big real estate investment trusts. Basically, invest into properties, and it was going to be a mixed use, commercial, residential, and retail. This is basically like the new trend in development, but that's a whole different story, and I don't want to get into that because that would take up the whole video. But yeah, so basically they committed to this lease, but they're not moving into it. It's really weird situation. Shopify is paying the rent, and it will not be allowed to break its lease, nor is it trying to break its lease. Shopify is a reputable company and an honorable organization, as are allied in Ryokan, and this was said by Ali's chief executive Michael Mori recently, back in 2018. They take 250,000 square feet from these real estate investment trusts, very big companies here, Canada, and then COVID-19 happened, and you could see here. Let's go on their stock. Their stock went all the way up, and they exercised another option for 90,000 square feet. Shopify says that they're no longer a workforce that centers around a physical workplace for day-to-day work. I am really curious on how expensive this lease was, because if you are losing money, okay, and you're losing a lot of money, and consumer confidence, investor confidence is going all the way down, you're just going to abandon your plans to work in the office. And yeah, you might be a more productive business at home or like in the work for home model, but you signed a 15-year-old lease. Like, you got to do something about that. At least that's something I would want to see as a shareholder. I don't think I can invest into a company like that makes these type of decisions. Like, this is very short-sighted, and it doesn't seem like the money is going in the best way possible. They're cutting off employees like crazy too. I can look this up for you guys just to show you. Yeah, like they plan to lay off 10% of the workers. Yeah, what's the PE of their company? I'm a little curious now before I end the video, but I think this is a very short-sighted decision. Maybe it'll show me here. Yeah, I don't know why it's showing blank. It's interesting. Let me look here. From what I remember when I was looking at Shopify, when it had that big run up, it was like 200,000 PE. No, not actually, but it was definitely climbing up there in terms of price to earnings. Yeah, so it still has a crazy PE ratio. I mean, this is just one metric of judging how, like, the valuation of a company. Yeah, it's just getting murdered right now. I would stay away from this company if I had to keep it as like a hold, a stay, or buy. But yeah, I would stay away from this company. It's really weird how sentiment changes, right? Like a year ago, I would have bought into the hype. I would have bought into Shopify. I was actually thinking about buying it. I thought I missed it. I remember it didn't have a stock split yet, so it was trading much higher. But yeah, I almost bought into the hype. And that would have been a very short-sighted decision, but that's something that I could have done. I think in hindsight, I was a worse investor then. But yeah, if you like this video, please leave a thumbs up. Let me know what you want me to cover next.